Hi guys, welcome to my channel. Before we get started, make sure to hit that like button, also subscribe to my channel. HLBLE to retire fast. So make sure to watch the full video. How to retire earlier. Depending on your level of preparation, early retirement might be either a dream come true or a nightmare. Can you really retire in your 40s? The answer is yes, but getting there is not simple. You must exercise extreme self-control and make significant sacrifices while you are young. Possessing a lucrative career is also beneficial. The surge in popularity of the FIRE movement coincided with a persistent bull market, which has bolstered the investments of FIRE supporters. However, retiring early also requires a little luck. If making significant sacrifices doesn't appeal to you, you might prefer a lower level of FIRE saving while leading a more typical life. 10 Determine the amount of money you'll require in retirement. Many people begin their retirement planning by coming up with a number, which is a mistake. The phrase, "If I can get to $1 million in my investment accounts, I'll be able to retire," is one that you'll frequently hear. Here is why this thinking is flawed. It doesn't matter how much cash you have on hand. What matters is how much steady income you can generate with it and other retirement income sources. Someone who receives $5,000 per month in fixed income from Social Security, pensions, and other sources won't need to save nearly as much as someone whose only fixed income is a $1,500 Social Security check to maintain the same quality of living. To maintain the same standard of life, the general rule of thumb is that you'll need roughly 80% of your pre-retirement income. This guideline states that a person with a $100,000 salary would require around $80,000 in annual income after retirement. Depending on your situation, this can be adjusted higher or lower. It could be a good idea to seek the advice of a financial counselor to assist with this phase. You might want to strive for a greater level of income if you intend to travel widely or indulge in pricey hobbies once you retire. On the other hand, you might be able to get by with much less if you want to live a simpler life in retirement. 9 Estimate the amount that will be received from Social Security and other fixed sources. When you have an income target in mind, the first thing you should do is take into account how much of it is going to come from fixed, dependable sources, without diving too deep into the specifics of how Social Security functions. It's probably advisable to keep Social Security out of your early retirement calculations if you want to retire before that time. However, you should definitely consider any pensions or annuities that will begin paying immediately after you retire if you have any. Let's take the case where you decided in step 1 that you would require $60,000 in annual income, or $5,000 per month, after retiring. If your pension will be $2,000 per month, you will simply need to generate a $3,000 income stream from your savings. 8 Determine your number. This is the step when you choose your savings goal. Take from your savings the amount of money you will need to generate. Then decide how much of your retirement money you can permanently withdraw without risk. The 4% rule is used by the majority of retirement planners in some form. This basically means that you can withdraw 4% of your savings during your first year of retirement and can adjust this amount upward for cost of living rises in following years, with little concern for running out of money. Though not perfect, this rule is a nice place to start. It's not too difficult to calculate the 4% rule. Simply double the amount of money you need to meet your annual retirement income goals by 25. For instance, if you need $3,000 each month, $36,000 a year from your savings, multiplying by 25 results in a target retirement savings goal of $900,000. 7. Assess your current situation. The following stage is to honestly evaluate your situation and the likelihood of early retirement. You might find it challenging to increase your savings to an acceptable level if you're 45 and want to retire at 55, but only have a $20,000 retirement savings balance. On the other hand, if your retirement savings requirement is $900,000 and you already have $500,000, you may be in good condition. Here is a brief graphic to assist you in figuring out how your current funds could realistically be expected to increase from now until retirement, depending on an average yearly return of 7% from your investments. If you wish to retire in, $50,000 could increase to $100,000, may inserir to $5 million could increase over 5 years. $70,128 backslash $140,255 backslash $701,276. 10 years backslash $98,358 backslash $196,715 backslash $983,576. 15 years $137,952 backslash $275,903 backslash $1,379,516. 20 years $193,484 backslash $386,968 backslash $1,934,842. 30 years $380,613 backslash $761,226 backslash $3,806,128. You can modify the numbers to reflect your existing savings using these charts. Simply double the appropriate figure in the $100,000 column if, for instance, you have $200,000 saved and plan to retire in 10 years. 6. Create a strategy for investing and saving. This is the stage where a qualified financial advisor, such as certified financial planner, truly provides value. It goes without saying that you are financially prepared to retire early if you set a savings goal and it already met it. On the other hand, a financial advisor may assist you in figuring out, among other things, how much money you should set aside and invest each month in order to achieve your objective, as well as whether your investing strategy is too risky or too conservative. Your present income will be plenty to save, or you might want to think about starting a side business to increase your savings, a financial counselor can tell you. 5. Take into account medical issues and other issues. Many people who aspire to early retirement overlook the following. What comes after that? After you retire, what will you do with your time? Will you take up a part-time position? Pursue a pastime? Worldwide travel? The point is that not having a plan is one of the most frequent reasons people end up regretting their early retirement. There are far too many alternatives to list them all here. In terms of healthcare, it's equally critical to have a strategy. If you don't already know, you must be 65 years old before you may apply for Medicare, regardless of when you retire or file for Social Security. If your employment doesn't allow you to keep your existing health plan after retirement, many public sector jobs, in particular, do this. You'll need to make arrangements for where you'll get your insurance from and how you'll pay for it. 4. Adhere to your plan. Last but not least, it's critical to continue with your strategy if your objective is to retire early. Setting goals and a course of action is only the first step. One tip is to automate your savings and investment strategy. For instance, if you and your financial planner decide that you should set aside $500 each month in your brokerage account, set up an automated transfer to ensure that it truly happens each month. Early retirement is undoubtedly an ambitious financial goal, but with the right planning, it may be made much simpler. Years before the average American quits working, you can start taking these actions to achieve financial freedom. 3. Contribute to a Roth IRA. Investors can save money and increase it tax-deferred by using Roth IRAs. Some income restrictions apply. If your modified adjusted gross income, MAGI, for 2022 is $129,000, $136,000 for 2023, or more annually, you are single and your contribution limit is decreased. You cannot make a Roth IRA contribution if you are single and have a MAGI of at least $129,000. $144,000 for 2022, $153,000 for 2023 or more. Couples filing jointly who have a MAGI of $204,000 in 2022 or $218,000 in 2023 are subject to contribution restrictions. The contribution ceiling is also zero at or above $214,000 for 2022, $228,000 for 2023. What is the maximum amount that could be saved with a Roth? Think about this illustration. A 40-year-old investor who makes $6,000 in annual investments and earns an annual rate of return of 8% has the potential to amass more than $473,726 by the time they are 65. Even someone who waits until they are 50 years old and begins saving $6,500 annually with the same return assumptions can save up to $190,000 by the time they are 65. For 2022 and 2023, respectively, the annual contribution limitations for IRAs, both standard and Roth versions, are $6,000 and $6,500. For those over 50, the catch-up contribution is $1,000. 2. Take home equity into account. Even though a property is typically not to be thought of as a key source of retirement income, it might offer liquidity. To that aim, senior citizens may think about borrowing against the equity in their homes to pay for living expenses. Most people in the population have their wealth invested primarily in real estate. There are numerous ways to use this to pay for retirement. To access the equity when necessary, you can use a home equity line of credit, HELOC, sell, downsize, or both. Whatever decision you choose, remember to take the effect on your monthly income into account. Make sure you can have a sustainable income for many years to come because people are living longer than they did decades ago. In Lexington, Massachusetts, Kirk Chisholm, a wealth manager with Innovative Advisory Group, says, for elderly borrowers, lending institutions may shorten repayment terms and raise payments amounts. Thus, a reverse mortgage can make sense. For older people, moving to a smaller, less expensive property instead of selling their primary residence altogether may make sense. Since children are frequently grown and living independently, they frequently no longer require a large residence. But it's important to take selling a house seriously. After all, obtaining full equity ownership in a property frequently takes the homeowner 30 years. Therefore, it would be unfortunate if you didn't make the most money feasible from a sale. Nevertheless, people ought to think about the state of the market and whether now is the best time to sell. Of course, homeowners should also take tax implications into account. Homeowners who are married and file a joint tax return can make earnings of up to $500,000 without having to pay federal capital gains tax. The cap is $250,000 for lone individuals. 3. This is assuming that you fulfill the following criteria. You must not have benefited from the capital gains exclusion on another home in the 2 years prior to selling the one you are selling, and the house must be your primary residence. 3. IRS Publication 523, which is available from the IRS, explains further criteria. Finally, consider the cost of living in the location you might be relocating to before making the decision if you're not merely downsizing to a smaller home in your existing neighborhood. To put it another way, you should make sure that the cost of groceries and other necessities is generally lower than where you currently live. 1. Implement cash value policies. Even while using an insurance policy's cash value should only be done as a last resort. It could still make sense to do so if the original necessity for the insurance is passed. To assess your specific needs, you should speak with a tax counselor and an insurance specialist before ever canceling a policy or taking cash value out of it. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go.